In the last 19 years, I've grown my hard money lending business from $0 to $50 million in loans. Now, don't be overwhelmed by that time frame because it really only took us a few years to get to this. And it grew quicker than originally expected. And then we turned it into a lifestyle business. Hi, if you don't know me, my name is Jason Balin from Hard Money Bankers, and we actively do about 20 loans per month as a full-time hard money lender and have been doing so since 2007. So today, I am going to reveal to you the three key lessons that helped us grow from deploying $0 to $5 million and then to $50 million and beyond. So I created a few slides for you as well, just so you can kind of follow along as I'm talking. But we're going to go through how to actually raise the initial capital you need for this business through something we like to call the capital raising blueprint. After that, we'll talk about deal flow, our online and offline roadmap for never running out of leads. And later in this video, I'm actually going to reveal the exact marketing funnel that we use to generate over 1,000 leads per month. And this is the most common over. And then lastly, we're going to talk about underwriting and structuring deals. I'll reveal the exact way we underwrite and structure our loan portfolio using the 4 C's of hard money lending underwriting, along with the exact underwriting checklist. And I'll show you how you can get a copy of our internal checklist as well. And I almost forgot. I'll show you exactly what type of team you need to set up as you continue to grow. And I'll show you our exact internal team that we have currently at Hard Money Bankers. And the reality is, if you don't get this last part right, then nothing else will matter. Now, what's crazy is that after we did this ourselves, we've been able to teach these exact same principles to over 100 other hard money lending businesses that have scaled to over $100 million, although most of them hover probably around the $20-25 million deployed or so. So by the end of this video, you'll learn the most important things in growing your own hard money lending business to the next stage, irrespective of your current level. But before we get to that, there's something else you need to understand. You see, scaling a hard money lending business is just like scaling any other business, which means what got you to $2 million will not get you to $10 million deployed. And most lenders get caught up around the $4 to $5 million deployed, and they don't really know how to get to the next level. But we'll get to that later on. Now, if you just want to work directly with me to make sure you scale your hard money lending business as fast as humanly possible, then click the link in the first comment of this video to apply. So without further ado, let's just get right into it. Here's a quick snapshot of some of our offices along the way. In 2007, when we started, as you can see, this was my house that we started in. That was from like $0 to maybe $1 million or so deployed. The next, we shared an office with a title agent, paid like $200 a month. That got us to, I don't know, maybe 2 or 3 million. After we were making kind of enough money to, start reinvesting in the business, we moved into this office. It was a huge, big office, if you can see this kind of on the right-hand side right here. And we got to about a good spot, like 10 million. Like we were a real business making real money. And then about 12 years ago, we moved into this office right here. And it's 3,500 square feet. We have pictures of our team, putting green, stuff like that. We kind of have a lot of fun in our office, but we do take it really serious and we work really hard. And that's where we've been at the $50 million mark. Still today. Okay, let's talk all about raising capital. Hopefully you can see my screen here as we go through it. So we realized early on that raising capital for our deals was easier than we expected. It definitely did not happen overnight. And we had zero experience with this when we started, but we did stumble through this, and it finally came up with a process that almost converted every single person that was interested in funding deals that we had. The process actually gets easier as you continue to scale as well, which I'll be outlining, here in a second. There are many ways to set up your capital stack. And I've seen successful lenders do all of them, from creating a fund to direct placement to borrowing the capital directly itself. Again, I'm not an attorney, so this may differ based on your preference and the state that you live in, but just don't get caught up on any of that for now, as the process is mostly the same. And the process is the important part, because no matter how your capital stack is set up, this system will work either way. So make sure you consult with your attorney to figure out what structure you want to use and what they recommend. There are many attorneys that concentrate in this space, and happy to share with you their contacts if you want. After you finish this video, just comment below and I'm happy to share them with you. Now, most lenders I know actually start out by bringing in the wrong type of capital. And before they know it, their capital investors are running the show and have way too much control that limits their ability to do the deals that they really want to do. Remember, you are or will be the expert. So you should be controlling the good deals that you're originating. You also get to dictate the returns. Our investors typically get 10%ish, and we deploy capital at 12.99 rate and 3 points. So as you can see on this slide, this is kind of the exact order that we operate with our capital investors. Now, if you're not familiar with DISC personality type, DISC, definitely familiarize yourself with that, because it's kind of an important aspect. So you know what type of capital investors to attract. Now, obviously, you don't or to target. You don't necessarily want to give them a DISC personality assessment. You don't really need to go and do that, but it is kind of important to know, what they are. We like to tailor D's and S's. So dominant personalities are typically business owners, other real estate investors, doctors, lawyers, things like that. They're alpha males and females that understand this stuff and they get it. And they're usually investors themselves, so they understand how this business works. It makes your life very, very easy. S is more steadiness. They're non-business people, but they have accumulated wealth over the years or some money over the years. Maybe they're your relatives or referrals, and they end up being a lot more passive as an investor. It's all built on trust. So they get to know you and they like you, and then they want to invest with you. And those two have kind of been the best. We try to stay from I personalities because they kind of talk a lot. They talk a big game, but a lot of times they don't have a lot of deployable capital. So, and the conscientious ones make it challenging, like the engineers and the accountants and things like that, because sometimes they'll talk themselves out of a really good opportunity, and it's just hard to work with them kind of at the beginning, because their attention to detail makes it very, very challenging for them to take action and do this. Now, again, a lot of people have different types of multiple discs personality types, but the D's and the S's we've had the most success with. And most of the investor base is usually like only 50,000 to 2 million of investable capital. A lot of them aren't whales. Typically, a whale is looking for a higher rate of return, or looking just for, this is a 10% return. This isn't a 20 or 30% return. They're looking for something a little bit more hands-on that they can achieve a higher rate of return. So we've had a lot of success between the $50 to $2 million price point. And then over time, some of these lenders and investors do put up more money, but it kind of starts with that. So we're going to go off. Let me change this pen color so you can see. We're going to do kind of start with the 1.0, and then we'll jump into the 2.0. So typically our exact process that we file is we get introduced to them one way or the other, through a referral, maybe a business associate, and maybe we meet them at an event. Maybe it's somebody you already know, and we email them some sort of pitch deck. Hey, my name's Jason. I work with Hard Money Bankers. We are, we've been doing some really good real estate loans to local real estate investors that fix and flip properties. Maybe they buy an investment property, maybe they're buying a commercial property, and they're looking for low leverage capital on a deal. If you're looking to potentially deploy money at first note, first lien positions, first deeds of trust projects, happy to have a conversation, right? Just something pretty simple, so they understand kind of the business model. And most of them do understand the business model up front. And then we'll send them our email pitch deck, very, very clean, easy, simple pitch deck that just shows a little bit about mostly case studies of deals that we've done in the past, just so they can do it. So then we usually do an in-person meeting and go over questions and, kind of do some Q&A with them. Now, the good part is they have the pitch deck already, so they've seen the sample deals that we do. And by the time you get to the in-person meeting, most of these investors or potential investors are already sold. And they're just kind of asking follow-up questions of what happens in this particular case situation. And the question that a lot of people ask, and that an investor is on board if they ask this question, is, wow, like these deals are really good. the borrower is paying, 13% in 3 points. They're putting down 30% of their own capital. They have a 700 credit score. What am I missing? Why don't they just go to the bank? And the rebut, which is great, is listen, most of our borrowers are very bankable and they could go to a bank, but banks don't like construction loans. Banks can't close loans in less than a week. Banks don't typically like working with real estate investors that own, more than a few properties. So they're able to come to a hard money lender like ourselves to bridge the gap and do a deal with them. The reason that they see the quality of the deals you're already working with is because you put them in your pitch deck up here. So they know. So by the time you have an in-person meeting, they're just asking a few simple questions and you can answer that, and rebut of why these deals are so strong. So that's the important thing. This part right here is probably one of the most important things that do not forget is typically you'll end the conversation and they'll say, yeah, I mean, this seems good. I'm happy to take a look at some deals. And then your response is, unfortunately, we don't have any new opportunities at this point, or our fund is full, or we can't support any new capital at this point. That being said, we are a growing company and I'm happy to circle back with you soon as new deals come in, type of thing, which is true because you probably don't have any live deals ready to go at this point anyways. So then what ends up happening is you put them on the shelf for about a month. You reach out a month later, say, hey, today's your day. We have a live deal. It's a new opportunity. It's got to close quickly. If you want to get in on our fund, or if you're doing direct placement, if you want to, co-lend with us, here's your time. Let's do it. Now, typically the conversion rate's extremely high because they already know the types of deals that you're going to do. And the next deal that you have available is going to be that exact same deal that was in the pitch deck, right? That was the example deal. So maybe maybe they'll need to get on the phone, do some Q&A. You email over your agreements, wire information, stuff like that. Get everything signed and you're good to go. So it's a really, really good formula if you follow it like that. You have to follow it like that. We learned this the hard way. There was lots of opportunities that we had in the past when we were starting and we were too desperate to get capital, and the capital investors saw that we were desperate and we needed the capital and they didn't want to invest. So this is a good system. And then you define the communication system with them afterwards. So let's jump into 2.0 because I think that's important. After you start raising capital, the capital continues to raise and raise and raise. Obviously, you got to be doing good deals and performing and making monthly payments and everything works out. But, we use our current closings as marketing. Hey, here's some new deals, recent deals that we did. We brought on these new capital investors. They're making a good return, blah, 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 blah. You're missing out. Also, at some point, you got to get proper software in place. Now, software usually comes in when you're about 3-ish million deployed, maybe a little bit more. You can piecemeal together through Excel spreadsheets and things before that, but proper software will actually help you raise capital. What do I mean by that? On an automated basis, the capital investors are getting their weekly or monthly returns, through monthly payments that are coming in. They're getting statements of what their portfolios looks like. So the software is automatically sending them money and, showing them reports of how their portfolios are performing. And after that happens, it's like, oh, great. This is great. I got this amount of money. I want to put in more money. I want to tell my friends. I want to tell my family. I want to tell my daughter. I want to tell my uncle. I want to tell this person. And it turns into a capital raising machine, which is way easier than what we used to do back in the day when we were hand delivering checks to people and prepping portfolio statements. Softwares make things way easier. The softwares in this space that most of the members of our community use is the Mortgage Office, Mortgage Automator, and lendersoftware.com. Those are typically, the hot ones that people are doing. Then, ask for referrals and, stick to process one. That's what ends up being, and continue to have that face-to-face interaction. Keep updating your investors of what's working, what's not working, and things like that. And just good things happen. And again, this doesn't happen overnight, but it snowballs very, very quickly, and it just turns into a capital raising machine. All right, so let's talk next about finding deals. Now, the most important part of finding deals is commonly overlooked. Also, real quick note, you can't raise capital if you don't have good deals. So it's super important to go raise good deals. Think about this. If I'm getting 100 leads per week in order to close 2 loans, and you're getting 10 leads per week in order to close 2 loans, whose loans are going to be better? Obviously mine. And don't tell yourself that you aren't ready to market, or you can't handle more leads since you don't have enough capital raised. The worst case scenario is you just end up doing better deals since you can just cherry pick the best ones. And it will help push you to go raise more funds if you need it. I know a hard money lender that always tells me he doesn't want to market or focus on finding new deals and just wants to work with a few of the same borrowers over and over again. Well, in theory, that's great. But what ended up happening is he eventually was convinced to provide higher leverage and lower rates to his borrowers who continued to work with him, meaning 100% LTV, cheap terms. So the borrower just, in essence, controlled the lender, and he ended up making much less money than he should have on these deals. And a few of his borrowers ended up defaulting on their loans. And because that was such a big part of his portfolio, it put him out of business. We used to lend to one of the biggest real estate investors in Virginia. And after doing over 100 loans for him, he tried to strong arm us to providing 100% financing at very cheap terms. We had to make a business decision to just not work with him anymore because we had a marketing machine set up with new borrowers coming in regularly. So didn't have to discount our terms or take unnecessary risks just to be able to do more deals with him. Now, are you struggling to get your phone to ring? If so, let's dive into this slide right here so we can show you exactly how to create your own marketing machine and your own marketing funnel. Okay, so we like to call everything our online, offline blend. So when you think of online, what do you think of? You think of social media marketing, Facebook, Instagram, LinkedIn, Google Business. We buy leads from certain lead providers like Connected Investors and Bigger Pockets. And then offline stuff is direct mail, or going to realtor offices, working with hard money lenders, going to auctions, doing offline things, going to meetup groups, probably the most important thing to do so. So let's work backwards real quick because I think this is important. I'm going to change the color of this pen to red. So database is the most important thing. The only reason that we market is to create a book of business and to create a database of leads and customers. Because guess what happens after you have that database? You can email them, you can text them, you can call them, you can mail them, you can direct message them, you could go to their house and set up a meeting with them. It doesn't matter. After you have a database, all of this helps. Now, listen, in a perfect world, a borrower will call you on the phone. They saw you at a meetup group. They call you on the phone and say, hey, Jason, I got this loan. It has to close tomorrow. I'm not going to call anyone else. Whatever your terms are, I'm going to accept them and we're going to close. That's great. But in reality, that doesn't happen all that often. What does happen is, hey, call just to get a little bit more information about your terms. I heard some good things about you, seeing what we can do. And then you have a good conversation with them. They're comfortable with you. They don't have a property under contract at this point, and then you hang up. And then that lead's gone forever. It's just like you walking into a store and them not having the product that you want, and you walk right back out of the store. Then you have to go, then that store has to pay for marketing and brand awareness to get you back into that store. Well, you don't have to do that with this if you create a database, because you meet people at a meetup group, find someone, on a social media forum, and you get their information, their phone number, their email address, their contact information. You put that into your database. And after that's into your database, you send them emails and text messages and ringless voicemails or direct phone calls, cold calling them directly. I shouldn't say cold call, warm calling them directly over and over and over and over again. And I'm going to show you some of the email stuff that we do because I think that's an important factor to go through here in a second. But that's the premise that so many people are overlooking. We do social media content every day inside our office, but I'm well aware that, everybody looking at that is not a lead, but they're going to see our stuff. We're working on ways, we're building credibility by doing that social media stuff. And we're figuring out ways that we can take somebody from watching a video or looking at a post or finding us online and getting them into our database so we can send them regular updates and contact over and over and over and over. What we do in our business is we typically will do 3 emails a week, some text messages, and a lot of outbound phone calls to the database. What I would recommend, if this is all new to you, is 1 email per week. Do 1 social media post, typically a case study. Hey, Borrower bought the property for $30,000. $130,000. They put $60,000 into it. Hard money bankers financed 150 of it. They resold it for $250 and they made a $40,000 profit. If you have a deal that you would want me to take a look at, happy to help. Before pictures, after pictures. Put it on social media, blast it out to your email list. Blast out testimonials to your email list of happy customers. Blast out any content related to real estate investing that will help real estate investors grow. So don't worry about an elaborate website. Don't worry about doing tons and tons and tons of social stuff. As you grow the company, you will have to do that. Don't get me wrong. If you're at 5 million, 1 to 5 million right now, this works. If you're at 25 million and you're trying to scale, you need to do significantly more of this. But most people don't even have this. So you have to start with this. But if you're at the point where you're just at a few $1,000,000, you got to do at least one a week to make this work. It'll go a long way. Let me think if there's anything else related to this particular subject matter. Any questions related to this, obviously just comment below this video, and happy to talk through some of this stuff. Look at some of our assets that we have in place on hardmoneybankers.com and a lot of the social profiles that we're currently working on. But this is the stuff that works. This grew our email database from 0 to 100,000 emails over a few years in time, because we'd go to every single meetup and get a business card, and then every night we'd come home, put all the people in the database that we met and we talked to, and we said, hey, listen, you cool if we follow up with you, send you some good stuff. People would come to our website, fill out a contact us form, a loan application form, right? And we would opt them in, and then we would put them in our database, and we would text them, call them, email them, and every time we send out an email, we do a deal. It's just like that. Send out an email. Hey, do you have a loan that needs to close before the end of the month? Feel free to reach out to Hard Money Bankers. We can close very, very quickly. We're local, easy, quick. And bam. Hey, I got a new deal. Got a new deal. So very, very powerful stuff that most businesses just aren't talking about. So we're going to jump into underwriting and structuring loans next. I think that's a very overlooked part of the business, and it's probably the most important if you're deploying your own money or if you're deploying other people's money. Now, this comes with experience. Remember, if you've been in the business for less than a decade, then the market has been only going up. Chances are any of the loans you have written are on properties that are worth way more than they were at the time of origination. So even bad loans you have done probably worked out. Exit financing through banks has also been easy to get for your borrowers. I was working with one of our lender clients a few weeks ago to help with a defaulted loan that he was trying to exit. The borrower paid $160,000 for the house. The renovation budget was $40,000, which ended up actually being $60,000 with overages, and it was listed for $299,000, which it ended up never selling for, and they had to drop price multiple times until now they're finally close to fetching an offer around $230,000 or so. Technically, the deal isn't a complete mess, except the lender didn't collect any payments for 1+ years either, because they agreed to back end them. So that ends up being like $26,000 more, or which ends up being like 1 year of interest, plus some insurance costs, taxes, and things like that they had to step in and make payments on behalf of the borrower because the borrower was out of money. They probably will scrape out of this thing and hopefully not lose any principal, hopefully, but certainly they're not making any profits on this deal. After the resale cost, they're going to end up getting netted out. Honestly, they got lucky that the market pushed the resale value of what it even was, because when we went back and pulled comps, those comps were in like the low 200s. So they got lucky. They're not going to lose everything. Crappy underwriting all around between not great collateral and lousy character borrower. That deal should have never been structured like that. We can dive into capacity and credit here on this next slide too. But please, please, please stop doing 100% financing. If you're currently doing that, it's a matter of time until you will lose a serious amount of money. Borrowers need to have skin in the deal, ideally 20% or more. The borrower had very little incentive to perform on this example I just said. He only had sweat equity, and that got eaten up. So most of the time, they're just going to walk away from their deal. And none of us got into lending to have to own and operate properties. Let me go over the importance of the 4 C's with you right now. All right, so here's the 4 C's of underwriting. Let's go through them one by one because it's extremely important to make sure you do this correctly. So, number one, collateral, the house. Collateral. Okay, that's the house. I'd like to draw out a house, but I'm not that good at drawing on this. So, it's got to be a good deal and it's got to be a property you want to lend on. If you know investment residential houses, but you don't know commercial, don't lend on commercial. If you know commercial, but you're not really too fond of residential stuff, then don't do that. Stick to stuff that you're comfortable with or that you're willing to learn about. What we like to do is lend up to 65% of the after repair value and no more than 80% of the purchase price. Man, I'm a bad drawer. No more than 80% of the purchase price and 100% of the construction costs. So what that ends up being is the borrower has at least 20% down payment plus closing costs. So usually that means the borrower is going to have at least 25, 30% of their own capital in the deal with closing costs. A lot of the deals we do are significantly more conservative than that, but like do not do more than that. You're going to get yourself in a pickle at some point, with this. And remember, go back to the marketing section if you need to remember to market so you don't have to compete on price or terms so you can continue to get good deals from some of these borrowers. So that's how we structure things, 20% down on everything. We want to make sure we have a 35% equity cushion. It's important to look at the as-is value and not just the after repair value. Nobody typically has an after repair value problem. This is an important aspect to think about. After, let's say you do a loan of $130,000 and a $200,000 after repair value. It's a $100,000 purchase, a $30,000 construct, a $30,000, or let's just say let's say you give somebody 100% financing because they're getting a good deal. Don't do that, but let's use that as an example. So let's say they buy it for 100, it needs $30,000 in work, and it's going to be worth 200. And you say, hey, Jason, I did a 65% loan. 100 towards purchase, 30 towards construction, 130 loan, $200,000 value, 65% equity cushion. You know what? That was a good after repair value loan. But you got to also remember what the as-is value is. What's the as-is value of the property? They're buying it for 100. It's probably worth about 100. And you gave them 100 on day one, right? Because you gave them 100,000 towards the purchase and then 30 towards the renovations. The 30 of the renovations are probably going to get put towards in a construction reserve, so you'll reimburse them as work's getting done. What happens if, God forbid, something happens with them and they get hit by a bus day one? You gave them $100,000 on $100,000 purchase price. You did 100% financing of the purchase price, right? By the time you take back that property, if it defaults, you're losing money on that thing. It is going to cost you money on that deal. You need to make sure that your exposure is good on day one, all the way through construction, all the way through resale. So have them put down money. It's the most important thing. Now, typically, up to 80% and up to 100% of construction, 80% purchase, 100% construction is for like A-plus borrowers. Good credit, lots of liquidity, have experience. If they're not that strong, or you got to discount that. Maybe do 70% of purchase, 60% of purchase, 50%, 40%. Whatever you're comfortable with that you think is going to work and they're going to perform. If you're in a state that has a long foreclosure process, you probably want to be a little bit more conservative as well, because that could eat up profit margins on your defaults. Borrowers that have experience on good assets make life easier for you. Another real quick thing on collateral, and then we're going to move on. Properties that were built after the 1970s or newer typically have less risk than the older properties because the construction component is significantly easier. If you're in a city that has, and we are in some of our markets that have properties that are built in the 1900s, late 1800s, 1900, 1920, those are big construction projects. If they're not a new experienced real estate investor, they're going to go over budget, and those are challenging deals to work. Okay, so the next thing, and this is order of importance: a collateral, character, capacity, credit, order of importance. So that's number one. Number two, character. Does the borrower have good characteristics? Do they communicate with you? Do they tell you the truth? Do you like them? Do you think they're going to be easy to work with? If a borrower is a bad character borrower, they are going to make your life miserable and potentially default, and you don't want to deal with that. These are the two kind of most important things. Obviously, it's got to be a good house, a good collateral, but they have to have a good character. We have to lend to good people that we believe can execute on the project. You don't want to deal with them if they have bad characteristics, make sure, we'll talk about credit, but make sure you're pulling credit. Make sure you're doing Google searches on them and their entities. You know, sometimes you can do background checks. We don't do them on all, but we do sometimes. You want to make sure they're going to be easy to work with. Make sure you're talking to them on the phone and at least Zoom. If you're just starting out and you have less than a $5 million portfolio, get to every freaking property and meet them. It's not good just for marketing purposes, but it's good for underwriting purposes, right? You can underwrite them. You can determine if you're comfortable with. And then on the other side, guess what? You see them 5 times over 9 months if they're doing a big construction project, because you get to go do every inspection. Plus, you met them up front. You build a rapport. And guess what? That turns into new deals. So that overlaps as well. Character, so important. Number 3, capacity. Do they have the ability to do the deal? Do they have cash, the down payment? Do they have an exit strategy that's viable? Do they have the ability to do this deal? So important. Capacity. Do they have the ability? Do they have an exit strategy? I'm working on a deal right now. Great collateral, pretty good character, but I'm nervous that they don't have the capacity to do this big construction project that they have in front of them. And it makes me nervous. And we're either going to discount the deal or don't discount the LTV, loan to value, or not do the deal at all because I'm nervous at their capacity on it. And then number 4, credit. Credit isn't everything, but it tells a story. I was underwriting a deal today with one of my business partners, and we have good collateral. We have good character. We have pretty good capacity. His credit is lower because he had a major family event, and late last year, he had to drop everything because he had an issue that he had to deal with his son for about a month or two, and he stopped paying everything. I was like, this hasn't happened much. Had a conversation, his story backed out, and we're like, listen, let me just pull your credit and let me see what's up. And if you've only ever had a late for 1 month and you missed everything and that's all it is, and now you're back on your feet completely and everything's getting paid and in good standing, I'm good with that. And his credit dropped low to like the mid 5s, and we still did the deal or doing the deal because it was an isolated incident and it made sense. It's usually not like that, but credit tells the story. Most lenders are not ordering credit. Ludicrous. First off, if you're doing, a fix and buy and hold loan, right? So somebody's fixing up a property, they're buying it from you, using money, fixing it up, and then going to refinance it through a DSCR loan. Like, you have to pull credit because once they don't have good credit, that's not going to be a viable exit strategy for them. The DSCR lender is going to have credit requirements. You need to be aware of that up front. You have to pull credit. You got to do it. It's an important way. It's an important way to do it. It tells a lot. All right. So I promised I'd tell you who your key employees are along the way. When to hire them, as well as how our setup is at Hard Money Bankers. As a $50 million portfolio. So typically between 0 and 4-ish million, you don't really need anyone. If you have a business partner, that's great. Typically the roles between you and your business partner would be, one person's front end, one person's back end. Maybe you overlap on marketing and stuff like that. And when I say front end is originating loans, processing loans, underwriting loans, getting everything to closing. The back end is raising capital, investor relations, servicing loans, dealing with defaults. So that's kind of front end, back end, and that's important stuff to know. You can do most of that stuff yourself at a few $1 million portfolio, especially if you get loan servicing software in place. That's big. As soon as you get to the 4 to 5 million, you need to have at least one person, and there is a challenge with that. So, typically hire 1 and hire 2 is a loan processor, and then a bookkeeper, accountant, loan servicer person. Those are typically the first and second. Now, I know a lot of lenders that are around $5 million that don't want to budget for both of those things, so they hire one, and that person does both tasks. Pros and cons of this. The biggest con of that is both those positions have very different personality types. And if you heard me talk about this personality type earlier, is for a front end person that's helping you with processing loans and they're kind of front facing to a client, you need someone that's got like an I and an S personality that has a little bit of C as well, but mostly kind of S and I. Take care of people. They're front facing. They're helping you get the deals at the table. They'll do what it takes to get things done quickly because real estate moves quick. And then the bookkeeper, accountant type of person is more of a C personality type. mostly just see. They're not usually front facing. Their attention to detail is great. They're always counting the money. They're good accounting types of people. So that makes it challenging. But if you are around like a $5 million portfolio and you're only looking to get a little bit bigger than that, one person's fine. If you're like 5 to 10 million trying to grow, then you need to have both of those people in place. And then after you get past like that $10 million mark, assuming you don't have a business partner, you probably want some sort of like business development person to help you as well. I'm a big proponent of running all your leads yourself, talking to borrowers, getting reps over and over and over and over and over after that $10 million mark. Then potentially you can hire that. Now, where we were at around 15 million was exactly where we're at today at 50 million. So this is what we have on our staff. We have myself, and I do, my high level role inside the business is underwriting loans. Obviously, I'm doing a lot of marketing stuff and business generation, but like my high level role is underwriting. My business partner, Chris, his high level role is investor relations. Then we have a full-time loan servicer, bookkeeper, accountant, and they live in our mortgage loan system, and they do all our bookkeeping, accounting, and servicing of loans. We also have a processor, which is we call a portfolio manager, and they do everything processing on the front end. And I'll tell you, one thing that most people don't realize is like our processor can process like 30 loans a month if they need to. Now we typically do like 20, but they can. I know a lot of lenders have come up to me and like, oh, my processor is so overwhelmed at 5. It's like, you need to put better systems in place and use your checklist, and they'll learn how to process more over time after they get used to it. When we started, I was doing like 2 deals a month, year one in 2007, and I was way overwhelmed because every time we needed something, I had to go create a doc. We had to do this, have to do that. But after you have systems and things in place, it makes things way easier to do so. We also have a full-time property inspector that goes out to every property, does valuations for us up front, inspections on the back end. And he's also created a book of business as like a loan originator. So he generates deals for us, and we also give him some of our overflow loans as well. And he's on the streets, talking to borrowers, meeting borrowers, talking to contractors, talking to realtors. He's out there doing inspections, so it's a good opportunity to generate business. And then we have a few different offices that originates business. That are just originators. We do all the back end stuff, but they're just originators in other areas and other markets. And then I do some origination, have a book of business as well. And there you have it. Those are the 3 key lessons that have helped us to grow and deploy, starting at $0 up to a $50 million portfolio. Technically, there was 4 lessons because I did want to talk to you a little bit about how our team was built and how you can build your team. Now, as I said, if you want to work directly with me to scale your hard money lending business quickly, then just click on the first link in the comments to see if you qualify.